Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, amidst volatility in equity markets, one way to minimize risk and diversify one's portfolio could be investing in international markets. So, how can retail investors invest in international markets, and what are the things that they must keep in mind before investing? Let's answer all of these questions with Arun Kumar, Head of Research, FundsIndia.com. Arun, good evening and welcome to the show. A lot of volatility and uncertainty in the global markets, but then do you think that's the right time to maybe look at these international markets, and if yes, what and which economy, which country?
Yeah, hi Kavita. Thank you so much for having me on the show. So broadly, if I take a step back and start asking the question, why do we need to internationally diversify? The starting point is that different stock markets of different countries do well at certain times and do badly at certain times. And the good part is that they don't coincide with each other. Now, just to take a recent example, the last 1-2 years, you would have seen the Chinese economy down by 5%. US was in a bear market of almost close to 25%, while US has recovered a little bit. And then on the contrary, you find that Indian markets have while they were stagnant for some point in time, today we are probably at all-time highs. So you will always see this pattern that at different points in time, different stock markets of different countries are doing well. So the overall idea is that no single, instead of putting all your money in a single stock market and hence completely being dependent on the vagaries of that market, if you can diversify across one or say few other global countries, then broadly you end up diversifying away some of the risk. Now, in terms of where does the risk come from? One, in terms of where is the particular stock market in the overall business cycle, in the overall economic cycle, what are the valuations in that particular market, what is the political conditions like, what are the broad macros like, where are we in the earnings growth cycle. So if you there are several parameters and most of these are at different phases in different countries. So which is why the overall idea would be that at least have a 20-30% to global allocation, and the remaining 70 to 80% can still remain in the domestic, which is the Indian equity market. So this would be the starting point. And again, there are two components to the global part. You can have a structural component where basically you say, I don't need to time it, but over a long period of time, I do an SIP, or whenever I get money, I put 20% to this particular market. The remaining 10% is probably where you can try to do tactical shifts based on where the opportunity is. So on the 20% basket, I think the logical step for any Indian investor would be to go look at US markets, because again, one of the largest markets, most of the products that we use, right from the app that we are using to communicate, most of it is US based companies. And again, it's a market with almost 100 plus years of track record. So US can be the broad starting point, and pretty much simple passive funds like either the S&P 500, which is more broad based, or if you wanted to be tech heavy, get into NASDAQ 100. So this can be your 20% allocation. The remaining 10% is where you can take a call based on where are the opportunities available at different junctures.
So the 20% allocation that can be into international markets should be a part of your core portfolio or your satellite portfolio. Only when you're ready with your core portfolio, you should be looking at this kind of diversification. Is that what you're suggesting?
Yeah, so as a part of the core portfolio, you can have 20% to let's say a very well diversified market like US. The good part about US markets is that you also, like most of the companies are already globally diversified. So almost 50% of their revenues comes from across the world. The remaining 50% is in US. Net by investing in US, you're almost getting an exposure to the end.
There is some connectivity issue, but then what Arun was trying to explain us is that 20 to 30% of your entire portfolio can be diversified into international markets. So Arun, are you back with me?
Yes, I'm back.
Please continue.
Yeah, so that was the broad logic, that 20 to 30% can be into global markets, and then 20% you start with US markets, predominantly S&P 500 or the NASDAQ 100, and this can be a part of your core portfolio. The remaining 10 is where you might want to take tactical allocation. So let's say today China is reasonably, it's almost down 50%. The valuations are reasonably attractive, but again, it is there for a reason. So if you want to take a bet on the valuation, saying that it is a reasonably low quality kind of a name from a pure
Tactical
parlance,
allocation
because
is very interesting, which a lot of experts don't land up, explaining our viewers. So China, you've mentioned, is reasonably affordable right now. So the time horizon is longer than 5 years. Is that how you should be aiming at this kind of allocation, which should not go beyond 10% strictly in your portfolio, because then that will just increase the risk in your portfolio, right?
true, true, and see, especially when it comes to any other market apart from US, you've got to be very tactical, because China is not a structural market. Because if you look at the last 20, 30 years, the returns have been very, very paltry. So you will occasionally find China. There are some. The government usually ends up doing certain actions, then suddenly the market tanks. Then the government again starts to become a little iffy on, I mean, little worried about what is happening. Then they again take some remedial measures. So Chinese markets have been extremely volatile. So it's something where, like, when the valuations are very cheap, you try to get in and then make returns over the next 1, 2, 3 years whenever you get the returns, and then come off at. So it is more like how most people try to play the PSU sector. Buy it really cheap and then you get out when it is cheap. So China should be looked at that sense. And obviously you have other markets, like you have the European market, you have Japanese market, you have Taiwan market, but all of these have their own nuances. So you'll have to pick and choose which is the segment that you want to get into. But I think at this juncture, there is a tactical opportunity to play China, with a clear call that you enter at low valuations and try to get in once the valuations start moving up. And it should not be a structural call. It is a very, very high risk bet. But at this juncture, it looks like from a valuation point of view, it does look.
Any other tactical allocation in any sector specific fund or a fund of fund that you might want to recommend or can think of?
See, right now we're not finding any major opportunities from I mean, from a sector perspective or from a tactical perspective. US, in fact, US itself was pretty cheap. Like we had given a call, like probably around October. We already had US as a part of our structural portfolio, but we also gave a tactical call to increase allocation to Nasdaq. That's kind of more or less played out in the last 3 to 6 months. But again, right now we're not finding any major place where the valuations are very attractive. Japan has kind of started to turn, but again, like it's a market which was probably stuck for almost several decades. So you might want to be extra careful about what is happening. So maybe we might want to wait it out for some point in time. Brazil, again, purely from a valuation point of view, looks very cheap. But again, it's again a market which is not played out well. Almost for last 10 years, it's been stuck, and you don't have too many options to play it from a mutual fund perspective. So overall, looking at it, my sense is China looks probably the a reasonable bet, but obviously comes with a 2, 3 year kind of a time frame, and it's usually a very, very volatile bet. So purely meant for a tactical allocation, and maybe start with 5% and then decide if you want to increase it further.
So be it tactical allocation or maybe just a part of your core portfolio, the route should be mutual funds. You don't really recommend direct stocks or buying direct equity.
Yes, mutual funds are a lot more a simpler route, and because
Sure.
you obviously you get the entire diversified basket exposure, because these are not countries where you can do the required research to pick individual stocks. So I think, and it's the evidence is overwhelmingly in favor of these passive diversified funds, where the US active fund managers are struggling to beat them. So for us to sit out of India and then try to beat the broader benchmark, I think the odds are not by our side. So my sense is to keep it really simple and to go play the passive benchmarks for the US, to play the US markets. And at least when it comes to China, you have one or two decent options. One is available, a JP Morgan fund is available through Edelweiss. So that's one good option to look at increasing, look at starting your exposure in China.
All right, Arun, thank you so much for being on the show today, helping our viewers as to how can they diversify internationally. Thank you so much.
Sure. Thanks, Kavita.
We move